these days, trading options is just about getting out your cell phone and clicking a couple buttons, and you can go on StockTwits and start talking smack with all these people and tell them that you know what's up and all this stuff. And I think people assume that market makers, it's the same thing. They just have some fancy computer program and they put a couple things in, run a couple algorithms, and that's the way trading works. Well, it wasn't always that way. And, I'll come on StockTwits and somebody will start talking a bunch of smack, and, you can't differentiate who from who online because everybody has a platform. The beauty of YouTube is anyone can do it. The bad thing about YouTube is anyone can do it. So I want to talk about where my roots come from, and I want to talk about what it was like for me learning how to trade and the hurdles that I had to face to be accepted in the business starting out. And I want to talk about what it was like to break into a pit. Now, when I first started trading, which was in 1994, 95, I got a job as a runner on the floor of the CBOE in Chicago. I got this job through a fraternity brother from college, and I started out making $300 a week running pieces of paper on the floor. So what that entailed was we come in and we'd sit at this booth. The floor had booths. It was a square, huge floor like an auditorium, and it had booths on the sides that went up these little auditorium steps. And each brokerage would have their own booth. And so a brokerage, and these people would be sitting at the booth called phone clerks, and people would phone in option orders to them. Then the phone clerks would print out these tickets and hand them to us, and we'd walk them out to whatever appropriate pit there was to the brokers. Now, their pits were these little sections of the trading floor, and there were something like 50-something equity pits, equities meaning stock pits, and each pit had a certain number of stocks, maybe something from 10 to 20 different stocks. And so if you were a professional trader or market maker, you would pick out one of these pits to go stand in and apply your trade, make your money, do your business. And mostly people would just stay in one pit and specialize in those particular stocks, make markets in those particular stocks that happen to be in the pit. Now, the pits were assigned stocks kind of in a rotational basis. So as new stocks became, as the exchange decided that different stocks were optionable, they would assign them to the next pit who was up for a new stock. And so generally each pit would have a hodgepodge of stocks that weren't necessarily related to each other. It's just what happened to come up for them at that time. So for me, I was trained for about a year. Once I got into a market maker firm as a clerk, I was supporting traders in different pits. We would practice with a blackboard trading every day after the close. And eventually, as I was promoted to trader, I went to San Francisco for about a year, where I started trading in pits out there. And then I came back to the CBOE and had to pick out a pit. Of the 50 pits, I had to figure out where I wanted to go. Now, what we would do to start to figure that out is the CBOE would produce these reports of volume figures per pit. And so we'd walk around and we'd kind of spy on each little pit, and we'd see, okay, how many market makers are in this pit? What's the volume? So we divide the volume of options by number of traders, and we could kind of rate pits that way. Now, traders would know that we were doing this, and nobody wanted you to come in their pit because if it was a lucrative pit, however many traders were there is how much the pie was divided among. So if the total sum of all the orders equaled, $1 million, $1 million, then if you got an extra guy in there, each person gets less. There's more mouths to feed. And so people would do stuff like try to keep it quiet. If there's a broker coming in with an order, you want to try to keep things quiet because you didn't want a lot of attention on your pit. You wanted people to choose another of the pits. If there's 50 pits, if a guy's looking for a new pit, well, there's 49 other pits for you to go to. Don't come to our pit. So it was kind of like that. And let's take a look at this picture behind me just for a second. And my head's kind of in the way, but you're going to see there's a whole bunch of people standing there. And if I just move to the side here for a second, we can take a look. Okay. If you show up in this pit as a new guy, you've got all these guys who want you out of there. They don't want you sharing in the pie. They don't want you around there at all. And so, that's great if you're on StockTwits right now and you're learning about options theory and which options I want to buy, and maybe I want to be a market maker. But you got to get past the entrance before you can even forget about your options knowledge, forget about what you want to do. You got to get in with this crowd of people if you want to trade, and they're going to do whatever they can to block you from coming in. Thus, the process of entering a pit is called breaking in, and it can be a trying situation. It's the kind of thing where like each of these guys is out for themselves. They each represent a different company, or they're on their own, and they don't want you there, and they're going to work together to keep you out. Anybody who actually is from the CBOE or spent, who was there back then will recognize a lot of faces in this group. And I can tell you, people in this picture will and would physically fight you to keep you out if they got in an argument with you. And that kind of stuff happened all the time. There's two of my dear friends right pictured in the front on the left there. Love you guys. But the CBOE back in the day was it was kind of a closed group, and you had to either know people or you had to just force your way in. Even if you knew people, people weren't going to let you in the pit, so you had to kind of just force your way in. Now, to understand some of the strategies for breaking into a pit, we need to talk about how a pit functions for a second, specifically. So I'm going to switch over to this other picture here. And this is a picture, if I can straighten it out here. All right, so this is a picture of a typical pit. And you have a broker standing in the front, facing the pit. Now, behind the broker is what's called the book. And you can't really see people standing there right now, but there are people standing behind there. Those screens are the option screens. It's going to show puts and calls for a specific option. You can see MRK for Merck right there. And the screens are going to have books of resting orders. So the broker's got orders in his hand. There are resting orders called the book, and so if a stock moves, you might want to execute one of those resting orders. So, for example, there's a call market. If the stock price goes up a little bit, there might be some calls offered, and at a certain point, you might want to buy them. Now, also, the broker might just yell out an order. He might say, these 50 calls, okay? And then the crowd would yell back at him, the market. And so how do you get the market? Well, some people would just read it off the screen in front of them. Other people would make their own market based on the stock and based on just being experts in what's going on. If you want to, you can update the markets on the screen, sort of tighten them up or put your own bid in so that you are represented as the best bid on the screen. But in general, the way a pit functions is, or did function, was sort of like a, it's kind of like the markets would be left wide, and so people would read the markets, and in general, the way a crowd functions is an order is split up amongst the crowd. So there's 3 guys. There's a 10 lot. Someone comes in, wants to sell calls on the bid. If there's 3 guys, 1 guy's going to get 4 and 2 guys are going to get 3. And it gets divided up that way. And this is the way a pit generally functions. In general, in the pits and the CBOE, market makers were not trying to actively undercut one another when things were working the way you like it to work. The markets were wide, and we weren't trying to tighten up the markets. We were trying to leave them as wide as possible. An order came in, it was split amongst the people. So when you come and a crowd would work together to make money as sort of like a team, and so when you come in to break into a pit, you're kind of upsetting the apple cart in a way. If you don't understand the dynamics of what's going on in the pit, of how to work together as a crowd, then you're going to piss everybody off. It's kind of in a way similar to like, when you go to a casino and you play like if you go to a casino and play blackjack with people, a lot of times people will get mad at you if you, if you hit when you're not supposed to, because it messes everybody else up. It's kind of similar to that in a way. But basically, when you come in to break in, you have to try to be the first one, because if you're the first one to get an order, then if you're the first one to make a market, then you're kind of in control of the situation. And you have to be respectful to the people around you, because you got to live with them. And so the correct way to break into a pit would be to be as fast as you could with the markets. And if you're in that situation where there's 2 guys and you, it's three guys and there's a 10 lot, if you're the first one on the trade, maybe you take 1. So it goes like 1 guy takes 5, 1 guy takes 4, and you take 1 because you're the newest guy. And so you got to be the first one on the trade as fast as you can in the markets, and maybe you take less than your share, giving respect. It's kind of, my friend Doug used to talk about breaking in as being analogous to being in jail, in a sense, in that there's all these men all around you, and they're savages, and so you need to gain their respect in some way. And of course, the brokers are in control of who gets what order, and the brokers can't go against CBOE rules, but they're buddies with their buddies from the pit. And brokers, if they make a mistake with an order and they're stuck on an order, generally the market makers will help them out. If I have a trade with a broker and he thought he bought 3 from me, I thought he bought 1 from me, the next morning when we have to reconcile the trade, if he made an error, I'm usually going to eat the error, take the loss, and go his way. And that's, it's just a courtesy that we would do for a broker. And so a broker knows that other traders have his back. He doesn't know if you as a new guy have his back at all. So it can be tough to break in. And then you got to be patient. You can't expect the first day for anything good to happen. There are certain pits that operated different from others. If you're going into a Cisco pit or a very liquid pit where there's tons and tons of people, then it's going to be a lot easier. But if you go into a very illiquid spot with small illiquid stocks, it's going to be harder. Now, people might get on me for talking about a pit working together, but the thing is if you're trading a very small illiquid stock and you're the only market makers in the world, and there's only a few orders a day, the only way you're going to be able to survive as a business is if you work together. The only way you're going to be able to provide the service for the liquidity for the retail market and the public is if you work together, because A lot of the people that were trading with us knew more than we did. In fact, most of the people that were trading us knew more than we did. There was a lot of shady people trading options. A lot of the customers were shady. They were wired. They had inside information. It was like some of the big upstairs firms, Goldman Sachs, Morgan Stanley, maybe, I don't know, Merrill Lynch. But a lot of the players were wired, and they would come down there. They would do a trade with us knowing that they were going to win and we were going to lose. And so to survive in that environment, we had to work together because we're standing there in the pit. We've got access to no information. We don't know what's going on. All we have is our wits about us, and we have to figure out how to make it. So let's get back to breaking in. So if you come into a pit and everybody's trying to work together, they're trying to keep the markets wide, they do something called leaning on an order. What that is if there's a book of 200 calls in a small stock, there's 200 calls offered at a certain price. Well, if the stock goes up a little bit, you could buy them, and maybe it seems like kind of a good deal. But you could wait a longer time and wait till the stock goes even higher to buy those calls. If they're just resting there, you could just wait until they're a really, really good price and then buy the calls. Or you could, if calls are resting in a book, you could sell some stock against them. And then if the stock goes back down, you could buy the stock at a lower price. If the stock goes back up, you buy the calls. There's all these games that you can play in a pit when things are functioning right, but if somebody's trying to break in, they can stop all the money in a pit. If somebody is skilled at how to break into a pit, they can take away all the profitability out of that pit. And they can continue to do that if they have enough backing behind them and make it so nobody makes money. And so the way you break into a small equity pit is you try to be nice at first, you try to work with people, you try to like be first on a trade and then step back, and you try to work with them and be a nice guy, and that might work for a little bit, but in a lot of pits you can be as nice a guy as you want and they're still going to try to cut you out. They're still going to be jerks to you, and this can go on for weeks where you're really fast, but they just either the broker doesn't really hear you, or the other guys are jerks to you. So if you're trying to break into a pit, you can try to be Mr. Nice Guy for a while, but if it doesn't work, you can start taking money out of a pit. Now, how would you take money out of a pit? Well, if there's resting orders that people are leaning on, there might be all these resting orders in the book. Generally, the pit will wait till the last possible second before they trade a book order. They'll wait until it's a good trade for everybody, and then they'll finally initiate the trade. If you're trying to break into a pit and people are being jerks to you, you could just go in and buy and sell every book, every resting order. You could just trade them all yourself at fair value, and then nobody makes any money. Now, that's going to piss off a lot of people, but it's something that you only do if they force you to. If people are just not going to let you in there no matter what, and you're being fast, you're there all the time, you're on the markets, paying attention, and they're still not letting you in, you can take all the money out of the pit. You could tighten up every market in the pit. You could say, all right, April 50 calls, I'm $2 bid at $2. I'm a pick 'em market. $2, tell me what you want to do. And if you have a lot of money behind you, now traders might trade with you. If you're going to make a pick 'em market, be ready to trade it. So, to successfully break into a pit back then, you needed money behind you. Fortunately for me, the company I was working for, Group 1, had a lot of money behind us, and generally any pit we went into, we had at least as much money as the other players in that pit. So, and people knew that. And certainly was helpful to break into a pit if you come from a company that people recognize and know. Now, Group 1, when I went to the CBOE, was not super, super well known, but it was getting to be more well known. Certainly on the PSE in San Francisco at the time, it was super well known. So as you see, there was a lot more to trading back then than just picking some option you wanted to trade and knowing how and trading that. or buying a condo or something like that. As a market maker, we were required to trade. If we started trading a stock, we were required to make markets in it. You have to stand there and make markets, whether you want to trade or not. And if somebody comes in and pays your offer, hits your bid, you're required to honor that market and trade with them. So as a result of that, we would generally have positions on that we didn't want to have on. We'd have like the opposite of a good position on. You know, if volatility was low, then that was probably because they were selling us tons and tons of calls. So a job as a market maker was to make a market in size. So if people came in and start buying stuff, we'd raise stuff up and be nimble. People came in and start selling stuff, we'd lower stuff down. Now, the mechanism for making the markets on the screen was something called auto quote, and it was a computer program that just you could enter in volatility. It would automatically change price with the stock price moving. It was connected to a ticker, but you could adjust how you wanted things done through auto quote. Now, the CBOE for a long time was a hybrid system in most stocks, and it was what was called a DPM system. So you have, for example, the New York Stock Exchange is a specialist system. That is, one company is granted the monopoly on a particular stock. The CBOE was a DPM system, which means one company is granted sort of priority status on a stock. So, for example, our company had a DPM. That meant that that particular pit was, quote unquote, sort of run by our company. And every order that came in, we would basically get to trade a higher percentage of that order than other people in the pit. In addition, we would be the ones who controlled the auto quote. And we didn't control the auto quote. Like, if people wanted to make a better market, of course they could. But in general, we would make markets and things, and we were required, even more so than just a regular trader staying in the pit, we were required to make markets in every issue in the pit. So when you broke into a pit at the CBOE, generally some company would be the DPM or the designated pit manager, or the sort of specialist for those stocks, and they would stand at the front of the pit, and they would all sort of have the same color jacket. A broker would generally work for them, and they would sort of be in control. And so you needed to get in with the DPM. Now, the DPM wasn't going to do you any favors as a new market maker just walking into the pit. But, of course, this was about also, who you knew, what you knew, and that sort of thing. So, breaking in was not a fun thing. And the hardest pits to break in were the most profitable ones a lot of the time. And for me, the big pit for me to break into, which was the hardest one, was Xilinx pit. And I'm going to talk about that in the next episode of Back in the Day at the CBOE, Breaking In. Thanks for watching. If you like this sort of episode, then leave a like or a comment down below, and we can do more of these. I really appreciate all the support, and I'll see you in the next one.